Hello, this is Collin host of Palisade Radio, here to tell you about an amazing event taking place from February 15th until the 19th. Palisade Global Investments is teaming up with the Real Asset Investor team and one of the largest real estate developers on the island of Ambergris Caye, Belize to throw an amazing 4-day event. We're gathering an exclusive group of 25 accredited individuals to network, learn new ideas from experts, all while staying at Ambergris Caye, Belize's newest resort, Mahogany Bay Village by Hilton. The conference is taking place from Wednesday, February 15th until Sunday, February 19th. Indulge in your prosperous future at Ambergris' newest resort for only $997 plus airfare. Accommodations, food, and drinks are included. Only a few spots remain. If you're interested, send me an email at collin@palisadeglobal.com. Welcome back to another episode of Palisade Radio. This is your host, Collin Cattell. Returning back on the program with us today is Jordan Roy-Byrne. He's the publisher of thedailygold.com. Jordan, thanks for coming back on the program.
Collin, thanks so much for having me. It's my pleasure.
Jordan, you put out these weekly pieces on our YouTube channel, Palisade Radio YouTube channel, which give technical overviews of the market. I suggest that all of our listeners go ahead and check those out. They're getting a ton of views these days and a lot of good information. But we also bring you on to have more in-depth discussions just on how the market's performing and a fundamental outlook of what you think is going on. The big thing going on right now that we discussed before the call and is pretty clear to gold investors is that gold is not performing all that well, but gold stocks seem to be doing quite well. What do you make of the divergence that's happening in the miners and gold?
Well, it's very encouraging for us investors, and Collin, this is something that I've been talking about for 3 or 4 years. I was kind of hoping, even when the sector got so oversold in 2013, 2014, I was just thinking, at some point the miners are going to start to lead. So better late than never, but I think we're really starting to see evidence of that, especially given the action of the last 4 or 6 weeks, and I'll explain why. Looking at the monthly charts, a lot of times I look at daily and weekly charts, and the moving average that I like to use is the 400-day moving average, the 80-week moving average, and the 20-month moving average, which are all generally equivalent. So when I'm looking at a monthly chart, I look at the 20-month moving average and then sometimes the 40-month. But with respect to the miners and gold, the 20-month moving average, if you look at GDX and GDXJ, and you just go back the last 5 years, you can see how I don't have the charts in front of me, but with respect to GDX and GDXJ and that moving average, during the bear market, there were 2 or 3 times where the miners rallied up to it. They didn't get through it. Now, what happened last year is, of course, they exploded and got way above this moving average. And that being said, we had this big correction, which, I thought we were going to have maybe a 30-35% correction. But looking at the large gold stocks, they corrected about 40-42%. And what happened in December is, in looking at that monthly chart, both GDX and GDXJ, I think they might have traded below the moving average temporarily, but they managed to close above the moving average for the month. And so that's a very good sign when you test a moving average or even go below it, and then you close above it to end the month. So in November and December, the miners they held above the 20-month moving average, and now we can see in January we're having this good move higher, which confirms that was an important low that was made in the month of December, at the end of December. And with respect to gold broke below, I believe, the 20-month moving average in November, and it closed below in December. And where we are right now, I haven't checked it, but I think gold is trading right around that moving average. And we'll have to see what happens with the rest of this rally in gold. I know I'm probably getting into the next question. I think gold can rally a little bit more here, but over the next couple months, it'll be interesting to see if the miners will remain above the 20-month moving average if gold has another move lower. And I think the miners will. I think this divergence that we're seeing, again, they held above the 20-month moving average. They tested it, closed above it in each of the last couple months. And so they haven't been below it since we were back in the bear market, whereas in the last couple months, gold fell below it, and even in this rally has yet to go above it. That's just a strong positive divergence. And there's also, I mean, it's difficult to explain without being able to show the charts to our audience, but there's also some other divergences in place. Whereas if you look at just how high the previous rally went, if you compare that to how high gold went, there's a divergence there just looking at the last 4 years of action. So, Collin, this is very positive. I mean, going back a year ago, the gold stocks basically, when the bear market ended, they were 1 week away from being in the longest bear market ever. Whereas with respect to gold right now, I think just in the last couple of weeks, if it's still in a bear market, I mean, depending on how you judge a bear market, but as far as how I judge it in terms of time, gold right now would finally be in its longest bear market ever. So that just tells you, and then you look at the fact that the miners peaked well before gold. I mean, the gold stock gold ratio, I mean, I believe that peaked in 2010. So it definitely makes sense that the miners are finally leading. And so I know that's quite a mouthful, but basically the action of the last month is really confirming that the miners are leading. And that's such a good sign, Collin, because I mean, we've been doing these interviews for a couple of years, and over the last year or so, in the back of my mind, I've been worried about, a big dollar rally, or gold maybe is going to retest its low at 1050, and that still could happen. But Collin, even if it does happen, I don't think it's going to hurt the miners that much. They certainly would trade lower, but it wouldn't be something to get scared about. Instead, it would just bring a really good buying opportunity before the market moves to much higher levels, which I know we'll talk about later.
Well, so many great investment ideas emanate from the discussions on this show. Case in point is something you brought up before the interview here, which I hadn't thought about, is optionality plays. And for our listeners that don't know, optionality is the concept of the leverage afforded by a large deposit, the resources in the ground. At low metal prices, those resources are relatively worthless. And as the metal prices move up, you get an outsized leverage return in the share price appreciation of those companies. Jordan, you've realized that this might be a good place to deploy capital right now because the metal prices are down, but the miners are moving up. Talk about that.
Well, with respect to optionality plays, I would say I'm actually, in the short term, I would avoid them until it looks like gold has bottomed. The thing I would point out about the optionality plays is I think there will be another great buying opportunity in those plays, because looking at the chart of gold, I mean, even if it has bottomed and the December bottom is a higher low, even if that is the case, gold has a lot of work to do to kind of grind higher. And so I just see those, and those stocks haven't recovered that much. So I wouldn't jump back into those yet. I would just say that they tend to be more tied to the metals. So they haven't rallied as much in the last month as these other stocks. So they're kind of lagging a bit. But the positive of that is at some point this year, those will provide a really good opportunity. And they, because they tend to lag the mining stocks or the gold stock sector in general, you can wait on those and you can jump into them even after there's confirmation that gold has made a low. And just the example, I'll go back to last year, and I remember buying into a lot of these optionality plays like in February and March, and they were still, I mean, they obviously weren't as dirt cheap as they were in January, as you know, Collin, but even just buying into them like a month to a month and a half after the low in January, they were still super dirt cheap. So that's my point on the optionality plays is those are more tied to the metals prices. And so with respect to gold, if I'm right and gold has another leg down after the short-term rally, I think for the optionality plays, there will definitely be another buying opportunity in those sometime this year. I mean, whether that's going to be in 2, 3 months or 6 months, I don't know, but it's just something to keep your eye on, because when it looks like gold is definitely bottomed and is going to start to rebound and perform better, that's when you want to get back into the optionality plays, because that's exactly when they'll outperform.
Jordan, as you know, we made a call for the bottom in uranium stocks back on December 8th, and since then the uranium stocks have been looking pretty good. I've noticed that you've started focusing on them. You've always talked about the uranium stocks, so nothing new there. But I want to get kind of a technical read on things because many of these stocks, Denison I can think of right now, the charts are starting to look very compelling, and they're nearing breakout territory. Some of them are up 50% already, but they're really just starting to, from a long-term perspective, look like they're going to break out. So what is your advice there? What are your thoughts on the uranium stocks?
Well, Colin, as you know, a couple weeks ago, I talked about the double bottom in the sector, which was very clear in many of the charts. And in a textbook double bottom, you really get this explosion off the second bottom. And that's exactly what we're seeing in the uranium stocks. Looking at URA, the uranium stock ETF, or at least I know that's one of them, that has a very strong double bottom in place. And I guess the very short-term target that I've been looking at, which is sort of, I think, 1850, 18.75, around that range. The URA last closed at 16.94. So maybe it has another 10% upside in this move till it starts to get to resistance. If I had already bought in and I was holding these stocks, I would definitely continue to hold them. I mean, as you know, these things they were in a 6-year bear market. They're extremely oversold. They're super cheap. And when things shoot up a lot like this, there's always concern that there's going to be there's going to be a big correction, and certainly that will probably happen at some point. But I mean, as you know, we're only a couple months into this move, and taking another look at the URA and looking at going a little further out, I also see resistance around 23, 24. So that and up to 25. So that's possibly, after it gets to this target around 18, 19, maybe it has a small correction there and tries to work its way higher to 23, 24, 25. But just looking at the chart, I wouldn't fear over like a big 30 or 40% correction yet. I mean, this thing could probably double and maybe move up even more than that before it has a big correction. If you're on the sidelines, I would wait for weakness, look at these stocks, and maybe if they correct 10, 12, or 15% immediately, then I would definitely jump on that. And look, it's just when you get these super oversold conditions after multi-year bear markets, these things are the moves are just so explosive, and they tend to have massive moves before you see a big retracement. And so I just think that the uranium stocks are probably going to continue to move higher until we see some correction that you might need to be concerned about. So again, if I had already bought into these things, don't worry about any corrections, keep holding. If I was on the sidelines, I would jump on immediate weakness in some of these names if we get 10 to 15% weakness. If you're waiting right now and you think there's going to be some big 20 or 25% correction, I don't see that happening until much higher levels. I mean, in the URA, it's probably at least has to go to the mid 20s before we see, some kind of a big correction. Maybe it'll go even higher than that before we get a 25 or 30% correction.
Circling back to precious metals, we don't talk very much about silver these days, but let's finish off with a discussion on the weakness in the metal prices, not just for gold, but also for silver. What do you see playing out in the rest of 2017?
Well, with silver, the thing that comes to mind with silver with respect to gold is, I've kind of been thinking if gold is going to make a new low, maybe silver will make a double bottom, considering that silver peaked in early 2011, so it peaked before gold. So in that similar vein to the mining stocks, against gold, silver should start to lead gold. But I mean, just looking at the chart of silver, it's kind of similar to gold. I mean, it's a little bit stronger than gold, but I just don't see anything that great there with respect to the chart. But the same thing we're seeing with the thing we're seeing in the gold stocks against gold, we're seeing a similar thing in silver. I mean, if you pull up a chart of SIL, which is the silver stock ETF, in December, that made a really nice bullish hammer, bouncing above its 20-month moving average, and that's being confirmed this month because SIL is already up 14% this month. And meanwhile, SILJ, which is the junior silvers, that has been so strong that in December it didn't even test its 20-month moving average at 10. I mean, it came down to $11, and I think it closes the month around 12 or in the very high 11s, and then so far this month it's up 18%. So contrast that with silver, whereas in silver in December, silver was battling the 20-month moving average, closed below it. Now it's kind of back above it. So unfortunately, I can't say much more than that with respect to silver. I just looking at the charts of gold and silver, I think the big move in those will probably lag the metals or lag the miners, as I've already said. But looking at the chart of silver, there's major resistance. It looks like around 21. You can draw a trend line from the 2013 or 2014 resistance. You can continue that line through the 2016 highs in the low 20s, and perhaps silver can break above that sometime next year. That's something I wanted to get into with the miners, if you don't mind going back into that. If you look at GDX and GDXJ, they've kind of been in this complex head and shoulders bottoming pattern since early 2013. And so I think they're setting up for a real massive breakout, but I've kind of been looking for that to happen, that move to start to happen at the very end of this year or sometime early next year. And that move would lead the move up in the metals. And so getting back to gold, gold has, it's kind of in the same pattern where you have like a complex head and shoulders bottom. And so, whether gold's low is at 1120 or it tests 1050 again in the next couple months, I mean, whether that happens or not, gold has clear multi-year resistance now around 1375. And so once gold breaks that, there will be upside to about 1600 based on my work. And so that big move, Collin, that move in gold is going to be led by the stocks. And as I said, I'm looking for that move in the stocks to begin at the very end of this year or early next year. And with respect to the metals, they will follow that move. But getting back to silver, the silver stocks, like the gold stocks, are leading the metal. So I know I didn't say anything groundbreaking in regards to silver and the metal, but I keep coming back to the stocks because they're really telling the story for the sector, and they're going to lead the metals higher. And it's just a question of, is that move going to happen, the middle of this year, the end of this year, early next year? I don't know, but that's what I'm keeping my eye on. And that when we start to see the miners move higher, towards the resistance of last year's highs, the metals will eventually follow suit.
Excellent. Jordan, thank you as always for coming back on the program. Once again, Jordan Roy-Byrne, thedailygold.com. Jordan has a great free service you can sign up for, and premium with his trading alerts and his portfolio of companies that he trades on a daily basis. Jordan, talk again soon.
Collin, thanks so much for having me.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?